Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets.
Ice raw sugar in New York. There's a lot to go through here and a lot of it is not very clear. Now, I've often mentioned how the bright green highlighted August 2022 to date uptrend, currently at 1923, how it did not act so much as a support or a resistance, but more as a nuisance. In the middle to end of August, just before we ran into the changeover gap, prices started their most recent journey higher, over the 21st century 50% absolute Fibonacci line at 1809, then over the 50% Fibonacci line of the April 2020 to November 2020 move, and that's at 1859, and then tackling all the moving averages, congregating around the nuisance that is the bright green uptrend. However, over late August to mid-September, this bright green nuisance caused market to turn and dip, and then to turn back up again, creating a bullish halfway hesitation that saw the top side targets, both primary and secondary, reached. The move up over the March 23 low at 2004 started the next phase of the market's rise. Now, we'd seen rejection there at 2004 weeks before, which to be honest looked at the time like long liquidation ahead of the long weekend at the time in the US. Now, I did put out there some 11 weeks ago that the action since mid-April might be forming a possible double bottom. This pattern looked for a while that it would not complete, or even giving a clue as to the direction or its validity. And I have stated that we would need to show or to see how the action developed there. I've been very, very clear on the wording I used when I said on this point 11 weeks ago, and I quote, "Please note this is a potential for a double bottom, not a potential double bottom. The distinction between those two is very fine but definite." End of quote. This did not take away from the far smaller August-based double bottom, which saw its topside fulfilled during late August and early September. So the rally continued with now a bullish halfway hesitation, and 4 weeks ago explosively reaching the topside target of this pattern at about the 21 even level and triggering the previously mentioned double bottom pattern, large one. This had a topside target in the 2340 area, which was reached 3 weeks ago. In the process of rising, the market also created the opportunity for two quite large patterns, or should I say one final pattern that may come from two possible developments. You see, the action since roughly January/February this year till now has set up the opportunity to be either a bump and run reversal pattern, typically a bullish pattern, but is prone to throwbacks down, or the alternative is a descending scallop pattern. A pattern that could be seen as either bullish or bearish on a larger scale. And very much depends on what the market does now between the recent high and the low seen in September, at least. If the market stabilizes, then prices could head significantly higher. If not, then significantly lower. However, these patterns are still not fully formed, though they have been formed enough for me to categorize the actions this year as being one or other of these two. Of course, further patterns could develop, and I'll go on to watch out for these. Now, there are three other features I'd like to discuss. Firstly, the gap at the top of the market 3 weeks ago. It was the teeniest of gaps between 23.23 to 23.22, but it was a gap and it was at the top of the market, which automatically made me suspicious of the top side. However, late 2 weeks ago, the gap was filled, so I'll not mention it again. Secondly, and possibly most importantly, is the possible and arguable bow tie formation made around the 16th of September of the short, medium and medium moving averages. Now, this is not a clean bow tie formation, not by any means, and the moving averages came in and exited out to the bow tie in the wrong order. But there is a possible case for such a formation, especially as all have headed in the direction of the upward market. No surprise there, really. I spoke on this pattern 2 weeks ago when I said, and I quote, "All I can add is to watch out for volatility in the future between the 15 to 20 sessions after." So that is roughly between the 7th of October to the 14th of October, end of quote. We are at the end of that window today, and so far nothing extraordinary has occurred. but there's still time left, even a delayed time, for something to happen, if only with a small window left. Finally, and this deals with the most recent action between mid-September to date, there is a choice for the market to make, either a possible double top, which honestly doesn't look that great a version of a double top, or a possible 3 falling peaks pattern. This latter pattern depends on one key feature, and that the market closes below the low of last week at 21.77. If we do have confirmed closes below this, then the opportunity is for a drop down to a primary potential, not a target as yet, but a potential down in the 21.30 zone, with a secondary harder to reach potential down in the 19.85 zone. The importance of this pattern is that development of the secondary harder to reach potential could influence the choice of either a bump and run reversal bottom or a descending scallop pattern. I must stress again that the potentials for a possible 3 falling peaks pattern is still just potentials, but ones that should not be ignored. ICE Europe white sugar in London. When looking at the action over recent months, I had emphasized and wish to emphasize again now some significant points. First off, the monthly key reversal down in July. This helped the move lower until mid to late August. 11 weeks ago, I spoke about a new pattern, a start of July to end of August bear channel. At the turn of 8 weeks into 7 weeks ago, prices punched up through the top of this bear channel, giving some opportunities on the top side. A primary target in the 560.90 area was achieved 4 weeks ago, and a secondary harder to reach target X1 up in the 599 even area was achieved 3 weeks ago. The move higher to achieve these targets was caused by the construction of a mid-August to mid-September bullish halfway hesitation, with an integral horn bottom that also achieved its own targets up in the 576.5 area 4 weeks ago. The action over late September has forced yet another pattern and resurrected an old one. The forced pattern is a lopsided island pattern with the 2 gaps seen 4 weeks ago, since filled in, and 3 weeks ago, which is still a live gap, so one's been filled in, one hasn't. However, I should add, it is not a great looking island pattern, not by a long chalk. For starters, the gaps don't line up properly, but it is out there, and I'm still watching to see whether the action since then justifies it. So far, it really hasn't, though prices have headed lower, and by its nature, this island pattern is a bearish pattern. However, as I said 2 weeks ago, and I quote, the opportunity for the downside is limited to perhaps where the flatlining medium moving average is, which is currently at 550 even. Now, and that's the end of the quote. Now, I also noted 2 weeks ago, and I quote, the capping action of the slowly declining gold long moving average right now, and that's currently at 582.30, end of quote. Which has continued to this day, and also continued, and I quote again, the resurrected older pattern is the late December 2023 to mid-April 2024 descending triangle. This pattern showed its worth back in April through to early August, when the market broke down through the base relatively early on and reached eventually both primary and secondary targets below. I once again highlight this pattern in dark blue as the market reaches the apex of the descending triangle this week, so that's 2 weeks ago, in the 605 area, end of quote. All this rejuvenated bearish pressures after a reasonable run upwards from mid-August would warrant keeping an eye below, as we have a couple of fairly free areas, one of which we are in now until the February 2017 high at 565, and then down to the 550 to 546.90 congestion, where we find the March 2017 high at 548.70 and the previously mentioned medium moving average. This would seem a reasonable pullback after the summer rises, but anything of note beyond that on the downside, and we'll have to look again. Sugar white premium spread. 24 weeks ago, the market made a huge combined weekly key reversal down and bearish engulfing pattern. I suspect this was in large part due to the London sugar month changeovers, but it nevertheless was a seminal moment and set in motion a lower market, though prices took their own sweet time in getting down there. Between mid-July to mid-September, the market had been testing the lows of early to mid-October last year, down in the 115 3/4 to 116 zone. I also noted many times that though we had been held up in that region for a while, this support may not have been as strong as seen back in October 2023, and this has proved to be the case. 3 weeks ago, I highlighted how the market made a significant weekly pattern, an immediate countering key reversal down and bearish engulfing pattern. punching down through this 115.75 to 116 even zone and down through the next congestion zone made up of the lesser Fibonacci lines at 107.75 and 104.75 to new lows not seen since February 2023. I said about the supports below 5 weeks ago, and I quote, "There are lesser Fibonacci lines further down at 107.75 and 104.5, but I'm not sure how good these are. The next support of note would be the lows of the first week of February 2023 at 83 even, the mid-February low at 83.75, and the early February low at 81.75, end of quote. I continued further, and it's an important piece which I dealt with, and I quote, "The only other feature to consider is a new one I've drawn on my weekly chart, which is not as yet established, but which deserves consideration. It is the April to date descending wedge pattern, currently 85 even to 119 even. This is still a nascent pattern, but one worth watching," end of quote. 4 weeks ago, prices breached and closed below this descending wedge pattern, and it no longer was a nascent pattern, but the main pattern for this market now. I added 4 weeks ago, and I quote, "The key feature to watch for, apart from the obvious break out of the descending wedge pattern itself, is when the lower trend line crosses the purple neckline extension to the significant February to September 2020 head and shoulders top, currently at 76.75. This will be approximately during the week ending the 22nd of November this year," end of quote. We have seen over recent weeks some of the effects of this purple neckline as it tried to hold up prices, failing to do so, and prices relying on the November 2021 low last week and the week before at 68 even to hold up the market. So what have we in the way of opportunities and barriers on the downside? I'll try and keep it simple and short, as the much larger picture has even me somewhat scared. For an immediate support below, continue to look at the November 2021 low at 68 even, and then the congestion between 55 even to 45 even, dating from July to September 2021. Now in the bigger picture, we have to look for the opportunities presented by this break below the descending wedge pattern. A primary target X would be in the 65.25 zone, just below the November 2021 low, and is doable. However, the secondary, harder, much harder to reach target X1, well, that would be in the 1 zone. Yes, 1 even. And this has got me somewhat scared, as this is below what I know to be prior lows, notably the 2009 low at 22.25. All this is without even considering the implications that just possibly, the move lower may have triggered targets finally for the huge 2022 to 2023 diamond top pattern. And I shudder at the thought of that happening.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.